Well, good morning or good afternoon, some places. Welcome to the Texas Mortgage Bankers Association 2025 and 2026 Educational Webinar Series. It's a part of the Education and Endowment Committee, led this year by myself and my co-chair, Elizabeth Miller. Today, our topic is much anticipated Leadership Roundtable, Navigating Strategy, Growth and Resilience toward 2026. This webinar should take about an hour, but feel free to ask questions throughout the webinar by using the chat or the questions window. Today, we have three very esteemed panelists. We have Steve Remington. Steve serves currently as the Chief Operating Officer of SWBC Mortgage Corporation, where he leads enterprise lending, operations, compliance, quality, and organizational performance. We also have Jennifer Hudspeth. Jennifer serves as Executive Vice President and Chief Operating Officer at DHI Mortgage, providing oversight of operations for over 2,300 employees. She also serves on the board of directors of DHI Title Insurance Company. And we have, last but by no means least, Jean Thompson. Jean serves as President and CEO of Interlink Mortgage, as well as being the majority owner of Interlink. So today's format is going to be question and answers, and I'm going to field the questions, and each one of these very astute people are going to chime in with answers. So Steve, I think we'll start with you. Is that all right? Looking ahead to 2026, how do you think the market will impact your overall strategy going forward?
There's been so much consolidation. I saw an article, I think it was yesterday. I think we've lost 30 or 40% of the originator and company capacity through mergers and consolidation. So you think about the big getting bigger, and then the lenders that have stayed consistent and steady. There's a lot of technology out there right now. There's a lot of AI. There's a lot of marketing. But I think fundamentally how you execute and how you create borrower trust will really set the excellent originators apart from the average originators. There's still a huge housing gap. We know that the first-time home buyers and affordability is a challenge, but they need that consultative approach, and they need to be handled differently than just an automated platform. So I think the lenders that have positioned themselves, let me clarify that. There's always going to be a place for the automated and the technology driven, platform, but the relationship lenders that can understand how to communicate, how to be consistent, how to execute will certainly have an opportunity, I think, to really succeed here this year and next year.
Well, thank you for that. Jen or Jean, anything to add to that?
Yeah, I mean, when you talk about, from a growth perspective, and one of the things that, to Steve's point, with the consolidation, I think comes opportunity, especially for your mid-tier IMB space of the business. My personal opinion is I thought it would have shown up a lot sooner, 2 years ago maybe, and I missed that mark. But we're starting to see, companies in the mid-tier space. You're gonna pick up some organic growth with the industry and the market itself, right? I think we can all agree that 26 should be a better year than 25 in the purchase and refinance space, as rates continue to improve, et cetera. But additional growth comes from loan officers and storefronts, and I believe that consolidation that we've seen over the last 3.5 years specifically is going to lead to some additional opportunities for well-run mid-tier IMBs.
Awesome.
I would agree with that completely. And, at the end of the day, we're a people business, and it's about building trust and relationships. And as AI comes into our space and we start to see that accelerate throughout 2026, we're still a people business. We just are going to be able to become more efficient and capture that through those efficiencies with the various AI companies. So I think it's going to be an interesting year. We're excited for the year, and I think there's a lot of opportunity coming.
So Jen, we were talking before, And since you're in the builder space, would you mind speaking to what we were talking about with regard to forward commitments in this interest rate environment?
Yeah, forward commitments are a different one. It's certainly something that is available to help with affordability. So we're very grateful that that is a lever that can be used for affordability, and buyers certainly respond to those. It's needed right now with a lot of borrowers that are having challenges qualifying. So it is something that I think will be around for a foreseeable future, and it's something that's been here for a long time. It's been in existence for over 30 years, as long as I can remember. It's been part of it, and it's used off and on to assist in the market space as needed. But we do think that it's something that's going to continue.
That's great input for everybody listening. Thank you. So Steve, let's run back to you from operations standpoint, which is your area of expertise. What are you doing to stay efficient and profitable in today's environment?
Yeah, so there's been a lot of talk over the last couple of years about outsourcing and offshoring, and there's plenty of great companies. I even have some good friends that I know that are in that space. But I think the technology has continued to accelerate in the development over the last couple of years, especially in the last 10 to 12 months. That automation is really the way to go. And I'm not talking about like AI and they're making decisions. I'm talking about automating how we work with the documents, taking the documents, indexing the documents, extracting data from those documents, perfecting that data. Because if you think about what we're doing at the end of the day, we're trying to put a loan in the servicing platform so we can collect the payments and pay their taxes and do all this information. And it's all information based. But the assembly line to do that is still so, even with all the technology we have, is still so fragmented, and it has to be reevaluated. So we're spending a lot of time on document automation, the data extraction, being able to analyze that data and run, income, asset, credit analysis, the audit trails of quality control and post-closing to reduce the multiple touches. Because if you start taking out the 3 or 4 passes through underwriting, or a processor being able to handle 30 or 40 files instead of 15 or 20, you then create a force multiplier in terms of your ability to execute and bring down your cost or scale up and increase your profitability.
So Jen, as a chief operating officer, what else are you doing in that space for efficiencies?
That's a great question, Tom. And I would say we're really looking at it through a little bit of a different lens than we have in the past. In the past, it's been every efficiency. Can we save a click here, a click there? And, we're really more moving towards, I think, as AI comes into our space, that we can really transform, as Steve was saying, how we handle business. And if a processor could process 30 to 40 loans, that's huge from a metric standpoint, and to support them in that. I remember many, many years ago as a processor having that many in my pipeline and scratching my head 15 years ago going, how are we at 12? So, it is one of those that is transformational. So we're really looking at, instead of casting that net wide on different tools and vendors, how do we really narrow and hone in on that? You may have seen our company invested in an AI software company not that long ago, a few months ago, and we're really excited to really partner with a partner and dive into it. We don't want to spread out as much. The other way I think it's changing how we operate our business is, things are changing so rapidly in the technology and AI space, machine learning, that you don't enter into long-term agreements anymore, because in 6 months it's changing. It looks very different. It may be obsolete in how you're handling and using it to support your business. So looking at it more from a real-time strategy and transformational change in our processes versus that one-off click efficiency saved is really how we're starting to look at it more so.
It seems like that speed is accelerating at a breakneck speed right now.
Yeah.
With all this stuff. Gene, so speak to that if you will, but also add in there for us how you're balancing cost control while you're still keeping employee engagement and good customer service.
Yeah, great question. So, the name of the game I think a lot of people agree with moving forward is lowering your cost to produce, right? And so, you've got a lot of different sizes of companies that are attending today. And one of the things that, you hear a lot of buzzwords being thrown around in our industry about technology and AI driving quote unquote efficiency. And it's all driven around, a lot of it today is driven around capacity, right? It's not necessarily going to eliminate a body today in some spaces. It's going to increase, as Jennifer mentioned, the amount of output that an employee can do, which is awesome. That is a big part of the game. The thing about it is that you have to have volume in order to realize that true cost efficiency. And so part of my caution or challenge would be to make sure that you truly understand what your return on investment is in that investment and when it's going to show up on your income statement, right? You can't get lulled. Like, you can go increase capacity today if you don't have the volume to lower your cost to produce. What you've really done is added an expense for the future. And we all have to be conscious of that. This game is changing rapidly. But the mid-tier size, your small to mid-size IMBs, I think part of the superpower is I saw a quote today, speed is a muscle, use it or lose it. I think it was in Chrisman or one of those, somebody was commenting, and it really resonated with me because that, a smaller to mid-size IMB doesn't have the capital to go create their own closed-in AI self-learning engine, right? But there are so many people chasing that space today in the fintech world. We're all going to be able to participate in it. You have to be aware of what's out there constantly because, as Jennifer mentioned, it's changing daily. And when the cream rises to the top, where it's actually implementable at a much broader level, then you've got to use your superpower as a mid to small size organization and implement quickly, so you don't get left behind. I think both those things are extremely important because I feel like if you're still alive today, you've analyzed and cut cost from a human capital standpoint. You've renegotiated your vendor contracts for those that would do it, with the exception of the one vendor that we all know on this phone. I won't name who it is, that I would like to call out, but I won't. But my point is your leadership's done that. If you haven't, that's a whole nother discussion. You're probably not on the call, right? And so moving forward, it's about, you've got your infrastructure, and for you to go deeper in cutting cost in your infrastructure, you're hindering your ability to grow in the future, right? And so now it's about being extremely smart about lowering the cost to produce where you can through opportunities that are surfacing, creating that capacity, and as well as taking care of some of the low-lying fruits that exist today. As Steve mentioned, there are opportunities that everybody can participate today with where AI technology is in creating better quality, which does have a very quick return on investment with first-time purchase rates, suspense rates, et cetera, where you can see real tangible benefit without a large investment of capital.
I was going to expand on that because you hit the nail on the head, Gene. There's a tremendous improvement in quality the more you can perfect that data, that you empower a more accurate, income calculation all the way through the process. You can cut down on the post-purchase churn, the repurchase defects. All that is kind of a soft cost that's kind of hidden in those balance sheets and those income statements over the years. Right. But the agencies are using so much big data and AI they know what loans to look for now. They'll find the loans that have issues. First time. They don't have to go look at 50 loans to find 2 wrong. They'll pull 10 and find 7 problems. So I think it's a necessity to have better control of your process. And then the other side of the equation is the recruiting side. So for like a company like ours or Gene's, I was on 2 different recruiting calls in the last couple of weeks, And the first question they ask about is, tell me about your tech stack. Tell me about your process. Tell me about your execution. And then they check it with talking to your team.
Right.
And so if you're behind, then you're at a disadvantage from a recruiting standpoint.
Yeah.
That's right. And the certainty, the earlier in the process, the loan process that you can have the certainty of the income, whatever that is, the smoother the entire process goes, the more efficient we are, the better outcome. We all know when you have that complete information up front and we know it's accurate and we know we have the income calculation, we know what we're pulling off the bank statement and working through, then you have less mistakes. And to your point, Steve, when you get to that back end, then suspense penalties are less. It's just that whole entire all the way through the process that creates that efficiency.
Wow, that's so great. So I'm just a little off topic here. You guys saw these questions, but what I think maybe some other people besides myself are thinking at the moment, how do you keep great employee engagement in the face of all of that detail and all of these changes? Especially, I mean, I hear people all the time talk about worrying about whether AI is going to replace them. So any one of you that wants to speak to that, I think that's something that would be valuable for everybody to hear your perspectives on employee engagement.
We just talked about that. We had our sales rally a couple of weeks ago, and obviously we're talking about the technology that we're bringing to the table to improve the experience and increase efficiency and make everybody's life better from the borrower through the originator, and beyond. But honestly, the biggest thing for me is that transparency, being able to be honest with your team. Hey, here's what we're hearing from you. Are we hearing you correctly? You have to be listening. You have to be asking questions, and you have to be transparent. Hey, here's what we want to do. Here's what we think we can execute on. Here's a timeline we think we can deliver. Does everybody agree? And then you get buy-in, and you can move forward. So I think having time together, collaboration time, you have a little family time. I think all those things are important. I know everybody's cost conscious about spending money, but there are some very strategic investments in your people and your time that I feel like, make a huge difference.
Well, and I think too that, and Jen, you mentioned this, but it's people business, and it's also people being employed. I know Simon Sinek says all the time, 100% of your clients are people, 100% of your employees are people, 100% of your referral partners are people. And if you don't, it doesn't matter how well you understand business, if you don't understand people, you got a problem.
That's right. Well, and I think this really crosses over some into culture. It is about communication. It is about transparency. And I think none of us can stand here today and say, no, we know exactly where our business is headed, but we know that we're guaranteed change. And we know that we can embrace it with our teams and we can communicate, here's what we're doing, here's what we're looking at, here's where we're headed. And we are a people business. We plan to stay a people business. That's what is at the core of our industry is relationships. And I really think with our teams, it's as much as we can be transparent and create that excitement and momentum of where we're going and bring them along as part of it. That's how we all win together.
Mm-hmm. Gene, what do you say about company culture? We all know that you have one of our favorite people as one of your employees, high level.
Very blessed. Yeah. So, I mean, we like to say around here, you give people the truth or they're going to make it up on their own. Right. Which aligns with Steve and Jen. I mean, that's communication, right? Transparent communication. People got to know how you're handling what the challenges are in the market, right? And there's multiple ways to communicate that. From a practicality perspective, Steve mentioned sales rally, right? We do an annual all company meeting. It's not just for sales, it's production, it's ops, it's admin support. It's expensive, it's 2 days, but it's the most important thing we do every single year. And we did it when I was half this size, and we did it in 2021, right? We know the other side of that coin. But in addition to that, one of the things that I think I just want to share, because it's easy to implement, especially as you grow, right? To maintain that personal face-to-face time at multiple levels outside of Zoom calls is in 20 and 21, we were doing a live stream daily. myself and my former partner, because things were moving so fast, right? Emails just didn't cut it back then. And we've continued that as an organization. And so it's no longer a live stream, but we tape a what was used to be the live stream. We call it a broadcast today, and we do a broadcast to the company that gets pushed out once a month. And it's myself and my partner, and we're talking about, the previous month. We're talking about where we are relative to the budget expectations that we set in January with all employees. We're recognizing people in operations and production and some anecdotal stories to boot, right? It just continues to maintain part of that culture because, when you have multiple locations, as everyone is aware, you can't be in all places at one time, and having face-to-face time with people once a year doesn't really cut it, right? And so communication, transparent, and the word that comes to mind always when culture is mentioned is intention, right? You have to be intentional about it. It is work, but it's extremely important.
And we like to say, do our actions align with our words?
There you go.
And that is critical in the success of a company. And we used to have a former president, Gene, that he said something very similar. He would tell us that when the human mind is left to assume, it assumes the worst. So be sure we're out communicating and
Well said.
updating our teams. And it's true. We can all look at it ourselves from that purview, and it is true. So we want to make sure, especially in the times that we're in right now, as quickly as things are changing and some of the volatility we've seen in the marketplace in general, we want to make sure we're in front of our teams.
Yes, ma'am.
That's such a great phrase about truth. Thank you for that, Gene, and Jen for the part about the human mind too. It's awesome. Keeping talent on board, keeping your best talent on board is one of the subjects that came up. I'd lead that question by saying, are the things that you've just talked about as important as compensation level, or more important than? Or Steve, you look like you got something to say.
I think so. I think that people can get competitive pay. They can shop that around, but the culture, the time, the attention, other things like talking about retaining strong producers. Obviously, if you can retain the servicing of the loans that they originate, then you're protecting their database and their portfolio. So there's a significant investment there in capital to be able to do that, but it does pay dividends over time. And then the other side is you make their job easier to do, make it easier for them to do more loans or serve more clients or families, or to work with more builders and realtor partners. That's going to make that relationship stickier. And on the internal side, you have to keep your ops team together. You got to keep your corporate admin team together. So being able to do, strategic growth and development opportunities for them. We do summits, like instead of all hands, we'll do an underwriting summit. We'll do a closing summit. And so getting that team together once or twice a year to collaborate and have that family time tends to help with the retention. It also helps with the leadership development because you can really spend time with those people and try to figure out how to promote them or how to grow them. And that tends to help with their ability to retain them as well.
Jen, do you at DHI have some specific thing you do each quarter or year or whatever for that?
We do bring our teams in, very similar to how Steve said, which, by the way, I love how you say the family. Spend time with the family. And we do bring our teams in. We have our compliance team in right now, and our loan products team is in. Last week we had our bombs and title in, our branch ops managers, and then our team leads in closing. So we do bring them in so that they have that time. I think one of the things we all found out very clearly in the pandemic is that we can run our businesses very effectively, virtually and remotely. But there is a distinct difference when we're in person. There's magic that happens, and you have that time to really connect and bond at a different level. And we've just found that you can't replace that.
Yeah, that's
Well said.
so good. Yeah, I just can't forget that we're people. That's the bottom line. Well, let's pivot just a little bit to innovation and growth. So the first question that was asked is how are each of you approaching innovation and growth? We've obviously talked about tech and whatnot, but also about partnerships and diving into that kind of growth. Any one of you can start.
On the innovation side, I could talk about that one just because I can probably do some cool analogies that I like cars. So if you can take an old beat up car and add a bunch of parts to it to try to make it prettier or faster, but at the end of the day, it's still an old beat up car. And so I have a lot of great friends and a lot of great companies out there in the mortgage technology vendor space that have these, bolt-on solutions to maybe your LOS or your POS. But over the years, we've added a ton of tools and we have a ton of vendors, but we've just added a lot of pieces and parts. And really, when you go back and look at it and say, okay, did that really make us any more efficient? The processors can't do more loans. The underwriters really can't do more loans. You got the compliance and all the quality control, inputs that they have to work through, plus the agency guidelines. So you really have to redesign your approach to a loan file and how you want to approach it from a technology stack and focus on the core process and the core discipline and not just look at it as, oh, that's a cool tool. I think I can make that work within my system and that hope that works out. You got to abandon that hope strategy there. But then the other side of that equation is, naturally a lot of my team's focused on that core operational manufacturing process, but there's a lot of energy and a lot of effort right now behind empowering the originator up front with better follow-up with their clients, better communication, more consistent communication, working their database. And so that's the piece that, depending on the structure of your organization, if you have a real entrepreneurial, model where each branch kind of does their own thing and each loan officer within the branch does their own thing, that might be cool and it might be desirable on the surface to that originator, to that branch. But at the end of the day, you lose a lot of opportunity by not having that consistency of how you approach lead management, client follow-up, client communication. And so I really think a lot of people should stop and reflect on that and think about, am I leaving money on the table because, oops, we weren't following up that client and they went somewhere else because somebody did give them attention.
Jen, good thoughts on
Yeah,
that?
I'm glad Steve said that. I mean, there are multiple models, right? And in that entrepreneurial model, it's about finding the balance between the autonomy necessary to run your storefront, which is part of what that value proposition is, but giving them the tools that they need for the things that they don't know, right? I think that responsibility lies with the organization, right? Where they're not out there trying to figure all that on their own because you run an entrepreneurial model, right? You gotta show them where they pick up the economies of scale. You got to show them where they can get better to run a better storefront. And it's different, right? Like if I was running Loan Depot, my philosophy would be completely different. I promise you, right? But that's not where my space is. And when you asked about compensation earlier, and I think it's apropos to innovation in technology. To Steve's point, and this may not be very popular, but I think you can get yourself in trouble trying to be a pioneer depending on what space you're in, right? Versus communicating with your people, back to both of their points earlier, and understanding where the funnels are, and then utilizing that information to try to open up those funnels where you're investing in tech stack, right, and processes improvement that actually move the needle for your organization. Because it's not about, in my opinion, what everybody else is doing. Right? It's about what your unique value proposition is to the market and to the people that you are recruiting. Everybody doesn't want to work at Interlink, and quite frankly, I'm not a fit for everybody. And the same for probably everyone on this call, right? And so you got to know what you're trying to attract, and then you've got, in my opinion, and then you've got to scale accordingly and set up your value proposition accordingly. And at the end of the day, to Steve's point, I mean, look, compensation is always important, right? Originators are salespeople. They're eat what you kill individuals. It's how they're wired if they're really good at what they do. And protecting that's important. Those are my assets, right? My assets walk out the door every day at 5 o'clock, period, end of story. Right. And so where we've got to focus in this space is ensuring that we are maximizing our economies of scale. We're looking at innovation and putting things in place and making investments that are going to drive our cost to produce down so that we're protecting the compensation of the individuals that call this place home that are driving the revenue, quite frankly. Right. If I was controlling the top of the funnel, my philosophy would be totally different.
Absolutely. Well, and to your point, Gene, when you talk about storefront, it's our business model. It's what people think of when they hear our company name, and how do we enhance continuously our borrower experience, our employee experience. We want to make sure that the technologies and the software that we're using are seamless, and that we can plug in various tools and we can evolve with the industry as we continue to change and enhance how we do our business and operate. So I think those are all really important. Another area I just kind of wanted to touch on a little bit when we talk about technology and efficiencies and cost savings is, we all got very excited, and it was an important part of our business to strive towards the e-note and RON and those electronic closings when we were in the pandemic. And I feel like our industry has lost quite a bit of momentum on that since that time, which is something that still brings customer experience and our own efficiencies internally. And, we've found that it's been far more challenging and more detailed than we anticipated to get across that finish line with the different agreements and investors and aggregators and such, to say, how can we consistently do e-note and RON and provide that service? We've struggled with some of the agencies on the government side being able to offer that and have a hybrid where you have a mixed wet note and electronic signed note included in those packages. So I think that's something that we're going to see quite a bit of efficiencies that will also move our cost per loan down too, as we can get closer to that.
I'm glad you brought that up, because we have a question from one of our audience that asks exactly that. What are all of your thoughts on the growth of e-note transactions in the industry?
We love it. That was I've been a big fan of it for many years. My last place, we had deployed it across multiple products before COVID, and then so when COVID happened and it became a necessity, it was easier plug and play. Here, I've been here almost a year now, and I was pleased to see a very robust single borrower experience from the POS all the way through the closing, including the e-note. And then figuring out, Jennifer, maybe we can even talk offline and give you some tips on what we've learned working with Ginnie Mae and the government loans and some of the other challenges there, because we're saving a ton of money. Because think about just the time, the shipping time, the touches of people, front desk, collateral person, warehouse bank, back to the investor. It's a lot of time and money, and then just the shipping costs and all that. So, and then losing notes. I mean, I could go all day about the topic. I'm a huge fan and have seen a tremendous lift with eClose. There's trade-offs. We talked to the sales team. I mean, when you completely do a digital closing, you lose the moment with the client at the closing table. So if some of your loan officers go to the closing table still, they would lose that opportunity. But if you do it right, and you do the hybrid, or you do maybe e-note, but they still have to sign a deed of trust or a mortgage, you can still get a few minutes with them, to celebrate and have that moment. But I'm definitely a huge fan of it just got a slow start. Is a huge lift for the industry.
Yeah. I'll take you up on that, Steve.
Okay.
Well,
hey, Tom, real quick before we jump off that, because once again, for some of the individuals, I mean, your secondary execution drives part of that decision today, right? Depending on how much you're servicing and how much you're not. Because to Jen's point, from an aggregator perspective, they are way behind. Way behind. Even your big aggregators that you would expect would be first in line, they're not. And depending on your execution we're all here for a reason, right? So at the end of the day, with margin compression, right? If you're in the small to mid-size space, execution is everything. And I know it's important to everybody, but service retained versus bulk delivery, servicing, release, or co-issue drives a lot of that decision today. But you've got to be competitive in our space. You got to be competitive to the street first.
Yeah.
Right. And so depending on how you're executing from a secondary perspective, doing e-notes, hybrid close, yeah, 90+%. I mean, if you're not utilizing the hybrid close today, you're, in my opinion, you're missing the boat. But true e-note, the industry itself is so far behind where it should be based on the leaps and bounds made in 2021. To Jen's point, it's stalled. It is not it appears that it is not a priority in the aggregator space today for the most part. I think that changes in the next 18 months. They're all kind of crawling there.
Yeah.
And it'll be great, but it's
But I
just
think
not
this
100% reality today.
Yeah.
I think this group should use their voices collectively. And if everybody in this membership and in this group, and maybe it's something we can talk about at the secondary coming up next week, is the more pressure collectively we put on the aggregators, they will light a fire. I mean, it took a lot of time over the last couple of years to get some of the aggregators to get to where they are today, or some of even the subservicers. You have to have your subservicer set up for e-collateral,
right.
things like that. So there's a lot involved, but I think that's something that as an industry, as a trade association, and as a group, if we're all collectively putting that pressure on those top aggregators to do that, maybe they'll listen and get it done faster.
Great point.
Yeah. There's no reason that we shouldn't have that available for all of our customers.
Yes.
Yeah.
Well, given that this is all about 2026, maybe that's an initiative for 2026, right?
Yeah.
Before we get back to our list, we also have another question from one of our audience members, Steve, relative to originators. And he says this: 100% agree with everything that you all have been saying and about operational efficiencies. But what are your thoughts on loan originators? Despite all of the consolidation, are there still too many, given the relatively static total market size? That's one. Two, what does the originator of the future look like, in your opinion, given the face of younger consumers and digital natives?
I saw an article yesterday. I think it came from, it was either Housing Wire or maybe it was an advisor sent it out to me. The 80-20 rule still applies. Maybe it's 70-30. So 70 or 80% of loans are still handled by the top 20% of the producers. Yes, the simple answer is yes, there are still too many. There's always been low producers and then the high producers that do the most. I think everybody's going to take a different perspective on, you either manage those low producers up or out. I'm not sure. Some people are okay with having them stay as long as they cover their expenses. So I don't think fundamentally anything's changed there, but there's definitely we have an age problem that none of us are getting any younger, and we're not bringing in a lot of new talent. So you do need to have a mechanism to foster development of new talent in your organization from an originator perspective. It's the only way that we can break some of the cycles that we want to break and get into the right alignment with where the clients are. You have to Gretzky said, you have to skate to where the puck is. We need to be, where the puck's going to be. So you need to invest in something to develop the next generation of originators.
Yeah. And they'll bring a perspective with them about the constituents that are their age as well, that we don't necessarily, when you see the color of my hair, we don't necessarily jive with all the time.
At least you still have it.
Well, we could go on about that too.
I don't know. I think too, when you get into first time home buyers, is that's the majority of our business, and they still need that human interaction. It's the largest purchase of their life that they've made, and they don't understand the process, and they want someone that they can talk with and have confidence in and rely upon throughout that process. I look at my two younger boys, and as they approach buying a home, I mean, they're not sure where to start. And I'm thinking, what kind of job have I done being in the business that they're not sure where to start? Well, you started at D.R. Horton, but we'll go from there. But it is, they want to talk with someone, and they're in that millennial group, and they want a loan officer. They want to have that interaction. They want to ask questions and that human component to it. So I think there's a part of it that absolutely remains the way it is as we evolve.
I think originators also need to adapt probably more rapidly, because I've seen this at multiple places now. People got really busy and had really great runs from 2015 to 2021, and printing money, loans out of their ears, couldn't even serve all their families and clients. And then when the music stopped and the business shifted and rates went up, if they didn't have their daily disciplines and their execution of their business models, then their business fell off. I saw $100 million producers go to $20 million, and some almost exit the business because they just couldn't feed their family anymore. So with the advent of AI and AI chatbots, customers are using AI to shop for mortgages now. And AI is telling the client, hey, go get loan estimates from 3 lenders. It's just picking up the CFPB's website and the know before you owe kind of language. But now people are shopping differently because of AI. So your loan officers need to either adapt to where the market and the technology is going from the client perspective or the demographic, or they're going to get shopped to death and they're going to give up.
Well, and speaking of the word hybrid, as it was related to closings, same thing for an originator. I am one. You have to have an online social media presence. That's probably not where you're going to get your clients from, but that's where they're going to go to research you. And at the same time, you also have to have a human interaction with them, I think. But Gene, what do you say?
Wow. I had this conversation yesterday with a 27-year-old that's in the business, and along the same lines that Jen and Steve both mentioned, like the truth of the matter is, 10 years from today, I probably have no business being the CEO of a mortgage company because things are going to change so much. And we have this huge gap, right? And so what's getting ready to change in probably the next 5 years, certainly in years 6 through 10, is the kids. As an example, a 27-year-old today still has parents that grew up in the age that wasn't digitally driven 100%. Right? We've all adapted. We're still in the business world. We have to make change. We have to learn, etc. Right? As that generational gap changes, and your 27-year-old is now your 40-year-old, right? And the younger generation today that know nothing else start becoming the next home buyer, our business is going to completely change. Now, where I think that happens is a consolidation in market share, right? So to Jen, I think Jen made the point, like my first job in the mortgage business was with an MI company. I quit after 12 months because all I did was drink and play golf, and I thought they were going to fire me. But it was the year, it was back when the MI business was fun, but it was the year that AUS was released. And every contract underwriter in the country thought they were going to lose their job. They thought it was over, right? And here we are in 2026, 30 years later, and we all still have underwriters, right? And so I believe there is a place, no doubt, for the originator and the human interaction. How much they interact is going to change dramatically in the next 10 years, and there will be a segment of the market. All you got to do is look at a couple of the competitors that we're well aware of, buying top of the funnel, buying the servicing, the origination platform all together. They're trying to control the top end of the funnel. That is going to be a part of the market. It already is today. It's just going to be enhanced. Yeah. And I'm not a licensing expert, so that's something that'll have to change from that perspective. But I mean, you can already get a mortgage today, quite frankly, without having a face-to-face conversation.
You may never talk to a human.
That's right.
It's possible.
But so
the differentiator is going to be, there's always going to be a need to educate. Just to what Jen's question, her son asking, I wouldn't know where to start. You have to educate. You have The loan originator can't just say, yes, I have that product, and yes, I can give you that rate or beat that rate or whatever it is. It's so much more into that debt management, financial wealth management, wealth creation, education on what avenue to take. So there's so much more different today. That there's people that have been doing this in their practice for years as originators, but you do have to adapt.
But here's where I think the beauty is, right? So we're already seeing it today with product search engines, different vendors out there that have taken AI and not only implemented it into the product search engine where it's pulling from all the guidelines. That's part of it. But a lot of them have knowledge-based systems, right? Which is the old FAQs that we all know that they've implemented into their AI strategy, right? And so you can dig deep outside of, well, it's just quicker to get to the Fannie Mae, Freddie Mac guidelines or non-QM guidelines or what have you, where it's interactive. My point is that a superpower for a loan officer today that's been in the business that became a knowledge expert, which I'm a big fan of, that's their superpower. They're a technician today, right? Someone that gets into the business right now has to spend years getting up to that level of technician. You can separate yourself. 5 years, 3 years down the road from today, maybe even shorter than that, but sometime in the next 5 years, your 10-year LO that is a technician today, you can have someone that you can train in a year and has tools that'll provide the same solutions that technician is giving today that no one can touch in their marketplace.
Yeah, spot on.
Right? So the beauty of that, it sucks for your technician today. The beauty of it is it gives us a platform to bring younger people into this business and get them up to speed much quicker, where it's a career that they want to have, right? I bet out of 100 mortgage bankers that I meet, 95 of them, none of them went to school to become a mortgage banker. They all fell into it, right? Friend, family member, you got roped into the business and you can't get out. We've got to turn the tide where people want to be in this business.
That's right. And that we're recruiting. And that, to your point, when you talk about the different generations, it's one of the most important things we can do as leaders is to have that generational training. We've got 4 different generations in our industry today, and we all look at it and operate personally, professionally very differently. And to have that understanding as leaders and how you manage the different generations, I mean, it's something that we've got to have knowledge and understanding of to be successful and to continue to evolve and bring new ideas in.
Yeah.
Yes,
Wow. That's amazing thinking there. I think that as we go forward, even us that have been in the business need to take that on and learn how to use these tools that you're talking about, Gene and Steve and Jen.
We had to build our own because there's just so many different ways to slice it, because the amount of questions that like an underwriting team or a product team get on a daily basis supporting all these originators, we were doing it out of self-defense, self-preservation. You need to empower them with the right toolkit to be able to navigate your own internal guidelines to understand and have a conversation. Okay, here's what I think I have. Tell me if I can do this loan, kind of thing.
Right.
I remember the days when you got it in the snail mail and you had to replace the pages in the book.
I remember that.
Yeah.
I still have my MRI books, the last ones that came
Oh.
over.
Oh, no, we had some
I
of
might
those
frame
too,
them
yeah.
one day.
Yeah. So we're getting down toward the end here. We have about 12 minutes left. So the last section of questions was about lessons learned and preparing for the future. So I'm going to just ask each one of you in closing to give your thoughts on what's the best possible advice that you would give other leaders in this industry. I think the TMBA does a great job. This committee actually putting together educational pieces for constituents. But if you guys could each speak to what's the biggest piece of advice you would give other leaders as they're trying to prepare for 26 through 36. Jen, we'll start with you. Sorry.
Steve and Gene are very happy with that.
I've got an answer, but I want to hear Jen's first.
I think as we go into 26 forward, as leaders, we need to stay engaged. We need to listen. We aren't acting as quickly because things are evolving so fast. And I think there's something to be said to stop and pause and observe and see where we're headed. We aren't going to be always that cutting edge. We want to see how things are evolving. We want to see things tried and true and how they work. We want to listen to our teammates. We want to listen to our borrowers. We want to listen to our vendors that are out there and where they're headed. And we want to be consistent with that. But staying engaged in organizations like the TMBA, the MBA, I think those are all so critical because they are out there advocating on our behalf. And we need to be joining those efforts and have our voice heard. As our industry evolves and transforms, everyone on this call needs a seat at the table. And if we don't define it, someone else will. And we need to be part of the solution in transforming what do we want our business to look like. So I just strongly encourage everyone to be engaged and have that seat at the table and let your voice be heard.
I mean, I can echo what Jen said. I mean, personal experience, I'm still fairly new here, I'm not even a year yet, but the first few weeks, I just sat with people and said, talk me through your day, your process, and just ask questions. Okay, why do you do it that way? How many times do you do that? And just really understand it. And come to find out, people, they want that kind of engagement. They want you to understand at every level of the transaction, from somebody that's sending documents in the mail to, processing a loan to ordering VOEs, that they need to be heard. They need to be engaged. And then that gives you a great roadmap for where are all the little efficiencies that you can incorporate to bring that cost down. And then to pivot on the other side is there's a lot of great tools out there and there's a lot of great systems, but even things like some of the vendor spend, back to that cost per loan. Are you ordering services that you really don't need? Are there verifications of whatever, fill in the blank? I'm not shaming any one company out there. There's a couple of very expensive ones that we all use, but do you really understand, do your team really understand, when do you need it? Why do you need it? What time do you need it? How many times you order it, to really understand that spend, because it can get out of hand in a hurry and it's hard to go back and change that behavior. People just, when you have dozens or hundreds of people clicking buttons, it's easy to get out of control. And then my final little piece of wisdom, there's a lot of tech out there. There's a lot of really good platforms. Do your due diligence and have a plan going into that. Because if you just see a demo and then you see another demo and you see another demo, you try to go on gut based on what demo looked the best. It's a lot more different. Make them prove it. Make them do a proof of concept. Show me, hey, run 10 or 12 loans through the system. And if they can't do that in real time, then it shows you how hard it might be to deploy or how it might not actually serve your needs.
Right.
Yeah, mine's probably a little more philosophical. I think first and foremost, you got to know who you are as an organization, right? When things get tough, I think there's a tendency to start looking for what's next, versus focusing on who you are and just being the best at who you are and what you provide and continuing to improve that. So know who you are, know your numbers. I've branched out, made more friends this year, thanks to Miss D, making me get out of my bubble. It's amazing when you start, and I don't mean this negatively, but it's amazing when you start talking to leaders, how disconnected some people have come at the top of the house from what's really happening. Right. So know your business as a leader, inspect what you expect. These are all diligence that you had to put in place over the last 3.5 years, respectively. Same thing in 8, 9, and 10, right? For those of us that have been around to see both of those. And execute with that same diligence as things start to get better. Right? Because it'll serve you. 100% it'll serve you. Lastly is, I think one word that everyone can take away that applies in every part of their business is be intentional. Be intentional about everything that you do. Try to be intentional about everything that you do. Relationships, decision-making, strategy, all of it, right? It'll serve you well.
Yeah. That's great. One of the things that I'm hearing from all three of you is if you want your people to be engaged, then you've got to engage with your people.
Yes,
That
sir.
is such an important, and be intentional about that.
That's
So
right.
important. Yeah. Well, I just want to say thank you to all three of you, Jennifer, Steve, Jean. This has been highly valuable. I'm sure that everybody listening today in person, as well as people that will go back and listen to the recording, going to get a lot out of this to set us all up for 2026. So thank each one of you.
Yes, sir.
Um,
Thank you.
Absolutely. Thank you for having
Yeah.
us.
So, and also thank you to the audience. This is my little outro here that appreciate everybody taking time to listen and to be part of this. The Texas MBA continues to work on bringing great webinars like this one. Check out the homepage at texasmba.org for the upcoming schedule and for all those emails from Texas Mortgage Bankers Association reminding you to register. Don't forget, coming up later this coming week, actually, February, our Southern Secondary Conference in Houston, February 23rd, 24th. It's not too late to sign up if you haven't done so. You're going to get a whole lot of great information there too. So thanks again, everybody, and we'll sign off now and thank you. Have a great day.
God bless, guys. Thank you all.
Bye. Thank you.